Bitcoin is a digital currency. It exists only online. Unlike traditional currencies, which are issued by governments and central banks, Bitcoin is created and managed electronically. This means there are no physical coins or notes. Instead, Bitcoin transactions are recorded on a public ledger called the blockchain. Imagine it as virtual cash. You store it in a digital wallet, which can be an app on your smartphone or a program on your computer. This wallet allows you to send and receive Bitcoin, just like you would with physical money. You can use it to buy things, but not all shops accept it yet. Some online retailers and physical stores have started to accept Bitcoin as a form of payment. However, its acceptance is still limited compared to traditional currencies. Bitcoin is different from traditional money. Banks don't control it. It's decentralized. This means that no single institution or government has authority over it. Instead, Bitcoin relies on a network of computers, known as nodes, to validate and record transactions. This means it's controlled by a network of computers. These computers work together to ensure the integrity and security of the Bitcoin network. They use complex algorithms to solve mathematical problems, which helps to confirm transactions and add them to the blockchain. People use Bitcoin for online transactions. It's popular for its speed and low transaction fees. Unlike traditional bank transfers, which can take days and incur high fees, Bitcoin transactions are usually processed within minutes. It's like sending money through the internet. You can transfer Bitcoin to anyone, anywhere in the world, as long as they have a Bitcoin wallet. This makes it a convenient option for international payments. But instead of dollars or euros, you use Bitcoin. The value of Bitcoin can fluctuate significantly, much like stocks or other commodities. This volatility can be both an advantage and a risk for users and investors. One Bitcoin can be divided into smaller units. These are called satoshis. Each Bitcoin is divisible into 100 million satoshis, making it possible to conduct transactions of any size, no matter how small. Think of them like cents in a dollar. Just as a dollar can be broken down into 100 cents, a Bitcoin can be divided into 100 million satoshis. This flexibility makes Bitcoin a versatile digital currency for various types of transactions. Bitcoin was created in 2008. This marked the beginning of a revolutionary concept in the world of finance and technology. The idea was to create a form of currency that was not controlled by any central authority, unlike traditional currencies issued by governments and financial institutions. This new form of digital currency was designed to be decentralized, meaning that it would operate on a peer-to-peer network, allowing transactions to take place directly between users without the need for intermediaries. A person, or group, using the name Satoshi Nakamoto created it. Satoshi's true identity remains one of the biggest mysteries in the tech world. Despite numerous attempts to uncover who Satoshi really is, the identity has never been confirmed, adding an element of intrigue and mystique to Bitcoin's origin story. The true identity of Satoshi remains a mystery. Some believe Satoshi could be a single genius, while others speculate it might be a group of people working together. This anonymity has only fueled the curiosity and speculation surrounding Bitcoin. The idea behind Bitcoin was to create a decentralized currency. This means that no single entity such as a government or financial institution has control over it. Instead, Bitcoin transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. This means no single entity controls it. The decentralized nature of Bitcoin makes it resistant to censorship and interference, providing a level of financial freedom and privacy that is not possible with traditional currencies. It's different from traditional currencies issued by governments. Traditional currencies, also known as fiat currencies, are subject to inflation and government policies. Bitcoin, on the other hand, has a fixed supply of 21 million coins, making it a deflationary asset. The first Bitcoin was mined in 2009. This process, known as mining, involves solving complex mathematical problems to validate transactions and secure the network. The first block ever mined, known as the Genesis block, contained a hidden message referencing the financial crisis of 2008, highlighting the motivation behind Bitcoin's creation. This marked the beginning of its journey. Over the years, Bitcoin has evolved from a niche digital currency used by a small group of enthusiasts to a widely recognized and accepted form of payment and investment. Since then, Bitcoin has gained popularity and value. Its rise has been driven by a growing number of people who see it as a store of value, similar to gold, and a hedge against economic instability. The history of Bitcoin is filled with ups and downs. Its price has experienced significant volatility, with dramatic increases and decreases over short periods of time. This volatility has attracted both investors looking for high returns and critics who see it as a speculative bubble. Its price has been volatile. Despite this, Bitcoin has continued to grow in acceptance and use, with more businesses and individuals adopting it for transactions and investments. It has experienced booms and busts. These cycles of rapid growth and sharp declines are a characteristic of the cryptocurrency market, reflecting the speculative nature of digital assets. Despite this, it continues to attract interest. Bitcoin's potential to disrupt traditional financial systems and its promise of financial sovereignty continue to draw attention from investors, technologists, and the general public alike. Bitcoin's technology relies on something called a blockchain. But what exactly is a blockchain, and why is it so revolutionary? Imagine it like a digital ledger, a record book that keeps track of every single transaction made with Bitcoin. This ledger meticulously records all Bitcoin transactions, ensuring that every transaction is accounted for. Unlike traditional ledgers, this digital ledger is not stored in one central location. Instead, it's distributed across a vast network of computers known as nodes, all around the world. This decentralized nature makes the blockchain incredibly secure, as there's no single point of failure. Every time a Bitcoin transaction occurs, it's recorded in a block, which is a group of transactions. Each block is then linked to the previous one, forming a continuous chain. This creates a chain of blocks, hence the name blockchain. This chain is immutable, meaning once a block is added, it cannot be altered. The blockchain ensures transparency because everyone on the network can see the transactions. However, the identities of the individuals making these transactions remain anonymous, adding a layer of privacy. This anonymity is maintained through cryptographic keys, which are unique to each user and ensure that their identity is protected. Beyond Bitcoin, blockchain technology has numerous applications, from smart contracts to supply chain management, revolutionizing various industries. As we move forward, the integration of blockchain into our daily lives is expected to grow, making transactions more secure, transparent, and efficient. New Bitcoins are created through a process called mining. It involves solving complex mathematical problems. Miners use powerful computers to solve these problems. The first one to solve the problem gets a reward. This reward is in the form of Bitcoin. Mining is essential for maintaining the Bitcoin network. It verifies and adds new transactions to the blockchain. The process of mining consumes a lot of energy. This has raised concerns about Bitcoin's environmental impact. Section 5. Decentralization, the core concept. Decentralization is at the heart of Bitcoin. It means no single entity controls it. This makes it different from traditional currencies. With Bitcoin, there's no central bank, there's no government controlling it. This eliminates the risk of government interference or manipulation. Decisions about Bitcoin are made collectively. This is done through a process called consensus. All miners on the network participate in this process. Decentralization makes Bitcoin resilient. It's difficult to shut down because it's not controlled from a single point. Section 6. The allure of Bitcoin advantages. Bitcoin offers several advantages over traditional currencies. One of them is its potential for low transaction fees. Since Bitcoin transactions don't involve banks, fees can be lower. This is particularly beneficial for international transactions. Bitcoin transactions are also fast. They can be completed within minutes. This is much faster than traditional bank transfers. Furthermore, Bitcoin is borderless. You can send and receive Bitcoin from anywhere in the world. This makes it a truly global currency. Section 7. Navigating the risks of Bitcoin. Despite its advantages, Bitcoin also comes with risks. One of the main concerns is its price volatility. Bitcoin's price has been known to fluctuate significantly. This can make it a risky investment. Another concern is the potential for illegal activities. Due to its anonymity, Bitcoin has been used for illicit purposes. Moreover, Bitcoin is still not widely accepted. This limits its use as a currency for everyday transactions. Section 8. Bitcoin in the real world. Despite its limitations, Bitcoin has found real-world applications. Some businesses have started accepting it as payment. You can now buy a variety of goods and services with Bitcoin. This includes online products, travel bookings, and even real estate. Several companies have invested in Bitcoin. Tesla, for example, purchased a significant amount of Bitcoin in 2021. Bitcoin has also gained recognition from some governments. El Salvador, for instance, adopted Bitcoin as legal tender in 2021. Section 9. The future of Bitcoin, a balanced perspective. The future of Bitcoin remains uncertain. Some believe it will become a mainstream currency. Others are more skeptical. Bitcoin's success will depend on several factors. These include regulation, adoption by businesses, and technological advancements. Governments around the world are still figuring out how to regulate Bitcoin. This will play a crucial role in its future. Despite the uncertainties, Bitcoin has already disrupted the financial world. Its impact on the future of money is undeniable. Bitcoin is a new kind of money. Unlike traditional currencies which are issued and regulated by governments and central banks, Bitcoin operates on a decentralized network of computers. This means that no single entity has control over it, making it a revolutionary form of currency in the digital age. It is digital and decentralized. This decentralization is achieved through blockchain technology, which is a public ledger that records all Bitcoin transactions. Each transaction is verified by network nodes through cryptography and recorded in a block. These blocks are then linked together to form a chain, hence the name blockchain. That means it is not controlled by any bank or government. This lack of central control is one of Bitcoin's most appealing features. It allows for peer-to-peer transactions without the need for intermediaries, reducing transaction fees and increasing the speed of transfers. This is particularly beneficial for international transactions, which can be slow and expensive with traditional banking systems. Bitcoin is important because it offers a different way to think about money and finance. It challenges the traditional financial system and provides an alternative that is more transparent and accessible. For many, Bitcoin represents financial freedom and the democratization of money. Many people call Bitcoin digital gold. This comparison is made because, like gold, Bitcoin is seen as a store of value. It is not just a currency but also an asset that can be held for long-term investment. Investors see Bitcoin as a hedge against inflation and economic instability. Like gold, Bitcoin is scarce. There is a finite supply of Bitcoin, which is capped at 21 million coins. This scarcity is built into the Bitcoin protocol and is one of the key factors that contribute to its value. There will only ever be 21 million Bitcoins. This limited supply means that as demand for Bitcoin increases, its value is likely to rise. This is similar to how the value of gold increases as it becomes more scarce. This scarcity gives Bitcoin value. Investors are attracted to Bitcoin because of its potential for high returns. Over the years, Bitcoin has seen significant price increases, making it an attractive investment for those looking to diversify their portfolios. People are interested in Bitcoin because it can be used to make payments online. It offers a fast, secure, and low-cost way to transfer money. Many online retailers and service providers now accept Bitcoin as a form of payment, making it easier for consumers to use their digital currency in everyday transactions. It can also be used as an investment. Many people buy and hold Bitcoin in the hope that its value will increase over time. This investment strategy has paid off for many early adopters who have seen substantial returns on their Bitcoin holdings. Bitcoin is still new, but it has the potential to change the world. As more people and institutions adopt Bitcoin, its influence on the global financial system is likely to grow. It represents a shift towards a more decentralized and inclusive financial future, where individuals have greater control over their money. Blockchain is the technology behind Bitcoin. It is a revolutionary system that has changed the way we think about digital transactions and data security. But what exactly is blockchain, and how does it work? It is like a digital ledger. Imagine a traditional ledger book, but instead of being on paper, it is entirely digital. This digital ledger is used to record all transactions that take place using Bitcoin. This ledger keeps track of all Bitcoin transactions. Every time someone buys or sells Bitcoin, the details of that transaction are recorded in this ledger. This ensures that there is a permanent and unchangeable record of every transaction. Imagine a book where every transaction is recorded. This book is open for everyone to see, but no one can alter the entries once they are made. This transparency is one of the key features of blockchain technology. This book is not stored in one place. Instead, it is distributed across a vast network of computers. This means that there is no single point of failure, making the system incredibly robust and secure. It is copied across a network of computers. Each computer or node in the network has an identical copy of the ledger. This decentralization is what makes blockchain so powerful. Each computer on the network has a copy of the blockchain. This means that even if one computer fails, the information is still safe and accessible from other computers in the network. When a new transaction happens, it is added to a block. Think of a block as a page in our digital ledger book. Each block contains a list of transactions. This block is then added to the blockchain. The blockchain is essentially a chain of these blocks, linked together in a specific order. This linking process ensures that the data remains secure and tamper-proof. This process is very secure. The use of cryptographic techniques ensures that once a block is added to the blockchain, it cannot be altered or deleted. This immutability is what makes blockchain technology so reliable and trustworthy. Let's say you want to send Bitcoin to a friend. You open your Bitcoin wallet app on your smartphone, which is designed to be user-friendly and secure. The app allows you to manage your Bitcoin holdings, view your transaction history, and initiate new transactions with ease. You create a transaction using your Bitcoin wallet. This involves entering your friend's Bitcoin address and the amount you wish to send. The app will then generate a unique transaction ID and prepare the transaction for broadcasting. This transaction is broadcast to the network. The Bitcoin network is a decentralized system of computers, known as nodes, that work together to process and verify transactions. Each node receives the transaction and begins the verification process. Miners, who are special computers on the network, verify the transaction. These miners use powerful computer rigs to solve complex mathematical problems, which helps to secure the network and validate transactions. This process is known as mining. They make sure you have enough Bitcoin to send. The miners check your wallet balance and ensure that you have sufficient funds to complete the transaction. This step is crucial to prevent double spending and maintain the integrity of the Bitcoin network. Once verified, the transaction is added to a block. A block is a collection of transactions that have been verified by miners. Each block contains a unique code called a hash, which links it to the previous block in the chain. This block is then added to the blockchain. The blockchain is a public ledger that records all Bitcoin transactions. It is maintained by the network of nodes and is designed to be tamper-proof and transparent. This makes the transaction permanent. Once a block is added to the blockchain, it cannot be altered or deleted. This ensures the security and immutability of the transaction history. Your friend now has the Bitcoin you sent. They will receive a notification on their Bitcoin wallet app, confirming the transaction. The entire process is designed to be secure, transparent, and efficient, making Bitcoin a reliable method for transferring value. One of the main benefits of blockchain is decentralization. No single entity controls the Bitcoin network. This makes it very secure. Hacking the blockchain is nearly impossible. To do so, you would need to control a majority of the network. This is extremely difficult and costly. Once a transaction is added to the blockchain, it cannot be reversed. This makes Bitcoin transactions very secure and reliable. Section 5. Transparency and Traceability. Benefits of the public ledger. The blockchain is a public ledger. This means anyone can view the transactions that have happened. This transparency is a key feature of Bitcoin. While individual users are not identified by name, their transactions are traceable. This transparency helps prevent fraud and increases trust in the system. It also allows for greater accountability. All transactions are recorded and auditable on the blockchain. Section 6. Scalability and energy consumption. Challenges to overcome. Despite its advantages, blockchain technology also faces challenges. One challenge is scalability. The Bitcoin network can only process a limited number of transactions per second. Another challenge is energy consumption. Mining Bitcoin requires significant computational power. This consumes a lot of electricity. Researchers are working on solutions to these challenges. New technologies and upgrades are being developed to improve blockchain's efficiency. Section 7. The future of finance. Bitcoin's potential impact. Bitcoin has the potential to revolutionize finance. It offers a faster, cheaper, and more transparent way to send and receive money. As more people and businesses adopt Bitcoin, its value could continue to grow. It could become a major global currency. Governments and financial institutions are also exploring the use of blockchain technology. They are looking for ways to improve their own systems. Section 8. Beyond cryptocurrency, blockchain applications in various industries. Blockchain technology has applications beyond cryptocurrency. It can be used in various industries to improve security, transparency, and efficiency. For example, blockchain can be used to track goods in a supply chain. It can be used to store and verify medical records. It can even be used to create more secure voting systems. The possibilities for blockchain technology are vast and still being explored. Section 9. Conclusion. A revolutionary technology with a bright future. Bitcoin and blockchain technology represent a major shift in how we think about money, finance, and technology. While still in its early stages, blockchain has the potential to revolutionize many industries. As the technology continues to evolve and mature, we can expect to see even more innovative applications emerge. The future of blockchain is full of potential. The world of finance is changing at an unprecedented pace. Traditional systems are being challenged by innovative technologies. At the forefront of this revolution is Bitcoin, a digital currency poised to reshape the global economy. This guide will provide a foundational understanding of Bitcoin and its potential as an investment. Prepare to embark on a journey into the future of finance. Imagine a currency that exists solely in the digital realm, free from the control of governments and financial institutions. That's Bitcoin, a decentralized digital currency operating on a secure and transparent network called the blockchain. Unlike traditional currencies, Bitcoin is not printed or minted. It is created through a process called mining, where powerful computers solve complex mathematical problems to validate transactions. This decentralized nature eliminates the need for intermediaries, allowing for faster, cheaper, and more secure transactions across borders. Bitcoin is essentially digital gold, with a limited supply and growing demand. Bitcoin's appeal lies in its unique characteristics. Its limited supply, capped at 21 million coins, makes it a scarce asset, potentially hedging against inflation. The blockchain's immutable nature ensures the security and transparency of transactions. Once a transaction is recorded on the blockchain, it cannot be altered or reversed, mitigating the risk of fraud. Moreover, Bitcoin empowers individuals by giving them control over their finances. It's a borderless currency, accessible to anyone with an internet connection, fostering financial inclusion and challenging traditional financial systems. Before you acquire Bitcoin, you need a safe place to store it. This is a crucial step in your cryptocurrency journey, as the security of your digital assets depends heavily on the type of wallet you choose. This is where Bitcoin wallets come in. They are essential tools that not only store your Bitcoin but also enable you to manage your transactions efficiently. A Bitcoin wallet is a digital storage solution that allows you to send, receive, and manage your Bitcoin. Think of it as your personal bank account for cryptocurrencies, but with more control and responsibility on your part. There are various types of wallets available, each with its security features and ease of use. Some are more user-friendly, while others offer advanced security measures for those who prioritize safety. Software wallets are applications installed on your computer or smartphone. They are convenient and accessible, making them a popular choice for everyday transactions and quick access to your funds. While hardware wallets are physical devices offering enhanced security, these devices store your private keys offline, making them less vulnerable to hacking attempts and online threats. Choosing the right wallet depends on your individual needs and risk tolerance. If you are new to Bitcoin, you might prefer a software wallet for its ease of use. However, if you are holding a significant amount of Bitcoin, a hardware wallet might be a better option for its superior security. It's crucial to prioritize security and select a reputable wallet provider. Look for wallets with strong encryption, two-factor authentication, and positive user reviews. Remember, the safety of your Bitcoin is in your hands, so choose wisely and stay informed. Section 5. Choosing your exchange. Navigating the Bitcoin marketplace. Bitcoin exchanges act as intermediaries connecting buyers and sellers. They provide platforms where you can exchange traditional currencies for Bitcoin and vice versa. When choosing an exchange, it's essential to consider factors like security, reputation, fees, and available cryptocurrencies. Reputable exchanges employ robust security measures to protect user funds. Conduct thorough research, read reviews, and compare different exchanges before making a decision. Section 6. Taking the plunge, your first Bitcoin purchase. This is an exciting step in your cryptocurrency journey, and it's important to approach it with a clear understanding of the process. Once you've set up your wallet and chosen an exchange, you're ready to buy your first Bitcoin. Setting up a wallet is crucial because it acts as your personal bank for your digital currency. There are various types of wallets, including hardware wallets, software wallets, and even paper wallets. Each has its own advantages and security features, so choose one that best fits your needs. The process is relatively straightforward. First, you need to create an account on a cryptocurrency exchange. Exchanges are platforms where you can buy, sell, and trade cryptocurrencies. Some popular exchanges include Coinbase, Binance, and Kraken. Make sure to do your research and choose a reputable exchange with good security measures. After creating an account on the exchange and completing the necessary verification steps, you can link your bank account or credit card to fund your account. Verification steps usually involve providing identification documents to comply with regulations and ensure the security of your transactions. This process might take a few days, so be patient. Then you can place an order to buy Bitcoin at the current market price. Most exchanges offer different types of orders, such as market orders, limit orders, and stop orders. A market order will buy Bitcoin at the current market price, while a limit order allows you to set a specific price at which you want to buy. The purchased Bitcoin will be transferred to your wallet, where you have complete control over it. It's essential to keep your wallet secure by using strong passwords and enabling two-factor authentication. Regularly update your wallet software to protect against potential security vulnerabilities. Remember, you don't need to buy a whole Bitcoin. You can purchase fractions of it, making it accessible to investors with varying budgets. This feature is particularly beneficial for those who are just starting and want to invest small amounts. Bitcoin is divisible up to 8 decimal places, so you can buy as little as a few dollars worth. This flexibility allows you to start investing without needing a large sum of money up front. Section 7. Safeguarding your digital gold security best practices. In this section, we will delve into the essential practices that every Bitcoin investor should follow to ensure the safety and security of their digital assets. As the value of Bitcoin continues to rise, so does the importance of protecting it from potential threats. Investing in Bitcoin comes with inherent risks. The market is highly volatile, and prices can fluctuate dramatically within short periods. This volatility can lead to significant financial losses if proper precautions are not taken. Additionally, the digital nature of Bitcoin makes it a target for cybercriminals who are constantly devising new ways to steal funds. It's crucial to implement robust security measures to protect your investment from theft or loss. Start by ensuring that your computer and mobile devices are secure. Use strong, unique passwords for all your accounts and change them regularly. Avoid using public Wi-Fi networks when accessing your Bitcoin wallet or exchange accounts, as these networks can be easily compromised. Enable two-factor authentication on all your accounts, including your wallet and exchange accounts. Two-factor authentication, or 2FA, adds an extra layer of security by requiring not only your password, but also a unique code generated by an app on your mobile device. This means that even if someone manages to obtain your password, they would still need access to your phone to log in. This adds an extra layer of security, requiring a unique code from your mobile device in addition to your password. Make sure to use a reputable 2FA app such as Google Authenticator or Authy, and avoid relying on SMS-based 2FA, as text messages can be intercepted by hackers. Consider using a hardware wallet to store the majority of your Bitcoin offline, safeguarding it from online threats. Hardware wallets are physical devices that securely store your private keys offline, making it nearly impossible for hackers to access your funds. Popular hardware wallets include the Ledger Nano S and Trezor. Regularly back up your wallet to prevent losing access to your funds in case of device failure or loss. Store your backup in a secure location, such as a safe or a safety deposit box, and consider using multiple backup methods, such as external hard drives and encrypted cloud storage. By following these security best practices, you can significantly reduce the risk of losing your valuable Bitcoin investment. Section 8. Navigating the risks, volatility, and market awareness. Bitcoin's price is known for its volatility, experiencing significant price swings in short periods. While this volatility presents opportunities for profit, it also carries inherent risks. It's essential to approach Bitcoin investment with caution and avoid investing more than you can afford to lose. Stay informed about market trends, news, and regulatory developments that could impact Bitcoin's price. Diversify your investment portfolio, allocating only a portion to Bitcoin to mitigate potential losses. Section 9. Embarking on your Bitcoin journey, a call to action. Investing in Bitcoin can be an exciting endeavor, offering the potential for significant returns. By understanding the fundamentals, setting up a secure wallet, choosing a reputable exchange, and implementing robust security measures, you can embark on your Bitcoin journey with confidence. Remember to approach investment with a long-term perspective, manage risks effectively, and stay informed about market developments. As with any investment, thorough research, due diligence, and careful planning are key to navigating the world of Bitcoin successfully.